Hello, Brian Weeks here again with another MMCD Contract Consideration. This longer than usual video, entitled Overhead and Other Costs Revisited, will cover several topics, including the meanings and differences amongst indirect costs, impact costs, general overheads, and project overheads. Which and when are these costs reimbursable? What are the allowed markups under various conditions? The new definition for other task-related costs. What can be included in quotations and when they may be altered later. Standby costs for equipment and labor, and the essential need for proper documentation from the contractor and impartiality on the part of the contract administrator. In an effort to make these concepts clear, I will provide numerous examples. As you can see, I've been with the MMCD Association and its predecessor over 30 years, with much of my time spent in developing and teaching courses. Since 2012, I've created this series of contract consideration videos to help those who could not take one of our courses or who just need a refresher. I was one member of the team who created the general conditions and other front-end documents in the 1990s. I've remained on the documents committee to clarify and improve the contract language and to adapt it to changes in technology and contract laws. In 2019, I recorded a contract consideration entitled Cost Types and Reimbursability. That video was an effort to answer questions our association had received about what types of costs could be billed directly on force account forms versus what should already be covered in the allowed markups on costs. In the Platinum Edition, the general conditions only talked about general overheads in a context which implied it was referring only to general corporate overheads, not overheads related to a specific contract. This got even more confusing in the early versions of the 2019 edition, where the only definition was for overheads without the word general in front, although the rest of the definition was identical. My video at the time was an effort to clarify the difference between indirect costs, impact costs, and overheads, and to break down overheads into three classes. This differentiation was not part of the MMCD general conditions, but I proposed it to aid contract administrators in evaluating what should be reimbursed on the basis of fairness. In 2024, the MMCD Association Board approved these three categories via supplementals. Unfortunately, the category of task overheads was still confusing to everyone, partly because good examples were hard to find. Given the continued prevalence of questions submitted, in 2026, the Documents Committee decided to eliminate the category of task overheads in favor of an expanded definition. We'll look at this change later. Thus, my earlier video is now out of date, so it's time to update the information on overheads. But first, I want to review other types of costs and how they fit, or don't, into the MMCD. As we begin, we need to have some common definitions. First, let's look at a project cost structure as the contractor views it when preparing a tender. At the highest level, the contractor determines the project expenditures to build the work. That is, the labor, equipment, materials, and subcontractor expenses, as well as the costs of site or project overhead. To this subtotal of hard costs, the estimator will add markups to cover head office overhead and corporate profit. Typically, these markups are spread uniformly over all work items in the schedule of quantities and prices, but sometimes the estimator will unbalance the allocation for earlier recovery of those margins. At the time of tendering, the estimator will not make allowances for either indirect costs nor impact costs. If either or both of these types of costs occur, those which can be quantified will later be added to the final project cost accounting by the corporate accountants. I've just used the terms indirect costs and impact costs without defining them. Let me do that now. Please note that these are not MMCD defined terms, so we must defer to common industry understandings. Indirect costs are typically those which are second level or once removed from project events. They are future or current consequences to the contractor resulting from events occurring on the current contract. But the owner on the current contract is protected against liability via GC 13.1.12, as I'll show on a subsequent slide. Indirect costs are most easily understood through examples. This slide gives some. Inability to bid or start another project on time due to a delay on a current one. Drop in morale and resulting work productivity due to poor supervision, administration, or project management. Reduction in corporate reputation when a project goes poorly. Loss of key employees due to morale problems on difficult jobs. Loss of planned subcontractor due to delay on the general contractor's work. An increase in bonding or insurance rates after a problematic project. Lost opportunities when dealing with claims and disputes. Additional time spent in administration and project management due to confused or missing instructions. Additional time spent in dealing with interpersonal friction. From my own experience, one of the biggest indirect costs we incurred was the lost opportunities our company missed because our president had to spend so much time looking backwards to deal with a large claim. Although we were ultimately successful at arbitration, this prevented him from looking forward and taking advantage of new opportunities during the year-long dispute resolution process. A final example is the all-too-real effects of diminished corporate reputation when a project goes bad, no matter whose fault it was. In my experience, there's always enough blame to share amongst all participants. These last two examples highlight a key element of indirect costs. They are almost impossible to quantify with any accuracy. As I mentioned, indirect costs are never priced into tenders and are not recoverable when doing work on a force account basis, per GC 13.1.12, as shown on this slide. However, the wording of GC 9.2.31 implies contractors may try to include them when responding with a quotation. Now, what are impact costs and how are they different? Well, like indirect costs, they are unexpected and never priced into the tender. However, they are the consequences to the contractor of events on the current project. They result from unexpected occurrences during the project. Unexpected means unforeseeable at the time of tendering, based on the information available about the site at that time to competent bidders. Thus, they are often eligible for reimbursement. Often, they are the result of delays, acceleration, changes, or extra work. Unlike indirect costs, they are observable on the project and can usually be quantified with some accuracy. Once approved, these costs are eligible for markups, as we'll see. Directed relocation to do work out of sequence will have significant impact on costs and perhaps even crew efficiency. If the occurrence causes a delay, then there may be impact costs for standby during the delay and acceleration costs to get back on schedule. It's quite common for scope changes or unexpected problems on a project to extend the authorized completion date into winter months. This has compounding ramifications, all of which are reimbursable, providing the contractor properly documents them. This slide shows some generalized examples. I'll give you a moment to look them over, or you can pause the video and look at them at your leisure. By their very nature, unexpected occurrences were not budgeted into the tender. Depending on the language in the contract, they may or may not be reimbursable. If they are the consequence of an issued change order, then almost certainly the owner will be responsible to reimburse the contractor. Then, reimbursement will be for both direct costs of dealing with the problem, plus the impact the event or occurrence had on the contractor's schedule, workforce, and efficiency. As we'll see in the next slide, these impacts can be for both direct costs as well as site overheads. On the other hand, if the impact costs were the result of weather or force majeure, the CA will be required to extend the contract duration, but the owner will not be responsible for subsequent costs. If the impact costs were the result of some action or inaction by a third party, then the contract language must be analyzed, as often owners will add supplementals absolving themselves of liability. A common example of that is refusal by an owner to pay for the delay and impacts of utilities not removed from the site when promised, even though the companies responsible may have contracts with the owner. Here's a real-life example of impact costs. In this situation, the contractor was laying sewer pipe in an area that had previously been approved for work after twice being evaluated by archaeological specialists. Nevertheless, the contractor exposed a skeleton, later determined to be over 700 years old. As Murphy would have it, the skeleton was right on the sewer center line. Upon notification, the CA immediately halted work and issued a change order to fence off and protect the area of the find. After a couple of days, when it became clear that the investigation would take some time, the CA directed the contractor to work on another branch of the sewer, which had originally been scheduled for construction later in the project. As a result of this, the contractor incurred downtime awaiting for instructions, then had to mobilize his crews and equipment to the second point, and later back to the original halt point. In addition, materials for the second segment had not yet been ordered and had to be rush freighted to the site. A scheduled paving subcontractor was not available at the new time, so additional costs were incurred to use a different one. Working out of sequence was inefficient, as not all the finalized drawing changes were available, so some work had to be redone. In order to get back on schedule when the original location was finally released for construction, the contractor incurred acceleration costs for additional overtime. Given these circumstances, you can see the owner became liable not only for the direct costs of the problem, that is, securing and protecting the find, but also the much more significant impact costs I just outlined. Despite the relocation, the project schedule was extended for several days, so the owner also became liable for all project overheads for those days. Finally, all the costs, both direct and overhead, were entitled to be marked up for general overhead and profit in accordance with GC 10. Now, back to the issue of overheads. Originally, the Documents Committee agreed with my breakdown of overheads into three types. The Association subsequently issued supplementary general conditions in 2024 and 2025 to define the three types of overhead costs. Here's the updated definition for general overheads. 1.37.1. General overheads means those costs the contractor incurs for facilities, staff, support personnel, utilities, consumables, and other costs to the contractor which are not directly expended for the contract. These costs include head office and other support costs which are not incurred on site and which are allocated across all projects. General overheads are to be included in all quotations and agreed lump sum pricing. Alternately, they are recoverable through the allowed markup when pricing is by force account. The fixed component of equipment rates is not included in general overheads, but rather is a portion of the standby rate or hourly operating rate when those are charged. Here are the key points of this definition. Firstly, these costs are incurred by the contractor whether or not they have one project, many, or none. But every acquired project is allocated some of the firm's general overhead on a basis determined by its management. Secondly, When a portion of a contract is being performed on a force account or cost-plus basis, GC10 allows the actual costs to be marked up 15% for general overheads, plus, in some cases, another 10% for profit. Thirdly, general overheads are not verifiable by the contract administrator without additional documentation. Now, here's the definition for project overheads. These are costs which are incurred specifically for a given contract, but which are not allocated to other projects. It's critical to understand that project overheads can only be charged when a contract's time has been extended by the CA. Project overhead costs may be recovered through an agreed unit cost per day of extension or by individually itemized costs when a pre-agreed rate has not been set. A key difference from general overheads is that almost all project overheads, with a few exceptions, are directly verifiable by the contract administrator or an inspector through observations on site. Bonding and insurance costs are one exception to my statement that project overhead costs are verifiable on site. They're clearly related to the project, not the general corporate insurance or specific tasks. When bidding, the contractor will obtain quotations for these costs and include them in the line item for mobilization, as they have to be paid immediately. However, they're based on the contract value and required timeline as known then. If either of these change due to approved change orders, the bonding company will become aware of it at project wrap-up and will send an additional invoice to reflect the change in scope and/or time. Because the contractor does not know the amount of the extra charges until the end of the work, they cannot be added to the daily force account forms. However, a standard warning to the CA and the owner that additional costs will be forthcoming at project wrap-up is a good reminder to avoid surprises. This is congruent with MMCD's no surprises principle. Here's a graphic to summarize the differences between general and project overheads. General overheads apply to the corporation, not the project. Rule 1, they're not measurable on site. Rule 2, they exist whether or not the contractor has any contracts to perform. They are recoverable when a quotation containing those costs is accepted or when force account work has the allowed markups applied. Project overheads are, by definition, related to the single project. Rule 1, with a few exceptions, they are verifiable on site. Rule 2, they are only cost recoverable when a contract term has been properly extended. In that case, they can be recovered by being included in an accepted quotation or via the allowed markups on listed force account items. Here's a comparison table showing when and how general versus project overheads can be recovered. When tendering or quoting, both types must be included. When on force account, general overhead is recovered by a 15% markup, while project overheads, if time was extended, are listed on the form or at a pre-agreed rate. When dealing with a delay for which the owner is responsible, the same rules apply as for force account. When a delay is due to weather or force majeure, time will be extended, but the owner is not liable for any costs. Some examples of project overheads should help to clarify the concept. Daily or weekly costs of superintendent and field staff time, including all benefits and burdens on their wages. Tool crib, first aid, and lunchroom trailers. Portable toilet rentals, including maintenance. Site vehicles, such as a welding truck. Traffic control personnel and equipment. Portable generators and light stands. Site security personnel and fencing, and many others, some of which are shown on the slide. There are a couple of points to note. 1. Remember, these only apply if the contract duration has been properly extended. 2. Be careful to avoid double dipping. For example, if a superintendent's daily rate includes an allowance for his or her vehicle, then that vehicle cannot also be listed as a daily cost item. Because of the confusion about the categorization of task overheads, formerly GC 1.37.3, and what would be allowed in this category, it was deleted in 2026. All of the cost items, which previously would have been covered by that definition, will now be listed as individual items on the force account form. A new category of other task-related costs has been defined and used in a new GC 10.1.16. Other task-related costs are recoverable costs related to a work item being constructed under force account, which are necessary but independent of the quantity of the work item being performed. They may be directly involved in the fabrication, construction, or installation of the work item and shall represent actual and necessary costs the contractor expended to complete the work item. If such costs were not incurred under observation by the contract administrator, they must be supported by verifiable documentation. This new category of other is intended to allow contractors to include items which do not fit the other four cost types. 3 examples. Costs to acquire permits for new change order work, such as for demolition or blasting. Required traffic management plan changes. A specialized site access safety instructor's fee. You may note that these examples likely involve persons not on site, thus making the claimed costs harder to verify. Take, for example, the need for a new traffic management plan to cope with work created by a change order. This plan will likely be created by a person in the head office, spending time creating the plan, taking it for approval, and possibly revising it based on the approving authority's comments. This time, as well as the permit costs, is legitimately charged to this force account work item under other, but the person's charge-out rate and time spent must be verified to the CA. This is the reason for the statement in the definition that documentation must be provided to the CA if the costs are to be allowed. Here's an example that occurs frequently and is a difficult issue for a CA. Suppose the contractor has included time on a force account form for a person who's not normally on site, perhaps the project manager or a surveyor with vehicle and equipment. The CA has to decide if this person is eligible to be listed on the force account form as a direct cost, or is included in project overhead, or is covered by the general overhead markup. Here's the results of the committee's evaluation. In the situation where the person is actually involved in the work task of the force account item, then their time can be listed for reimbursement just like any other worker. That labor cost will be entitled to be marked up 30.3%, as I'll show on an upcoming slide. The vehicle and equipment can be listed under equipment and is eligible for a 15% markup. In the case of working on the force account item, the contractor must show that it was both needed for the item and not included in the burdened rate. In the situation where the project time has been extended by a change order, then the question becomes, is that person project overhead or general overhead? For the purposes of this example, let us assume that the person is either present on site 1 day per week, that is 20% of their time, or can be documented to be working on this project even if not on site for 20% of their time. In that case, 20% of the person's time at fully burdened rate is eligible to be included in project overhead, and hence is entitled to be marked up 15%, as I'll subsequently show. In the case of a time extension, the equipment may be idle, but still must not be included in the burden rate. As always, double dipping is not allowed. By this I mean that if the person is being paid as a worker, they cannot also be paid as project overhead on the same day. Moving on, I'm going to review the recently changed allowed markups under GC 10.1, starting with labor to show how the 30.3% value was determined. In 2025, a supplementary GC was board approved which increased the allowed markup for general overhead from 10% to 15%. The markup for profit remained at 10%, as did the markup for small tools at 3%. However, as a result, the compounded markup is now 30.3% on a fully burdened hourly rate. The calculation is 1.03 times 1.15 times 1.10 equals 1.303, or 30.3%. Also note that a supplementary approved in April 2025 increased the limiting cost for a small tool to $1,000 to reflect the increased costs of such items. The same supplementary increased the allowed markup for general overheads on all equipment from 10 to 15%, hence the 15% I used in the gray area example. Note that this 15% includes both general overhead and profit. The same supplementary also increased the allowance for general overheads and profit on both materials and project overheads from 10 to 15%. As mentioned, a separate supplementary was later added to cover the new category of other task-related costs, with the same 15% markup allowed for general overhead and profit. Now, let me touch on quotations. If time and circumstances permit, the CA will normally issue a request for quotation to get a price on additional work that the owner may want or require to be done. If there is no time for a quotation, or the situation is such that a realistic quotation is not possible, for example, the extent of the rock to be removed is unknown, then the CA must issue a change order designating the scope of the change and the fact that it is to be costed on a force account basis. If a request for quotation is issued, the contractor is obliged to respond with a complete quotation. If the work must proceed before the quotation is accepted or negotiated, force account forms must be submitted daily until the change is complete or another pricing mechanism is agreed upon. Once again, keep in mind that general overheads are covered by the allowed markups, but project overheads are only included if the contract time has been extended. GC 9.2.3 requires that any quotation provided be complete and represent all costs and time required for the proposed change at the time the quotation is given. This is similar to the requirements when tendering. The makeup of the quotation is proprietary to the contractor, and they're not required to reveal how the quoted price was determined, even if the CA requests them to do so. Clearly, the owner is not obliged to accept any quotation, but if it is refused and the work must be done, then pricing will initially be by force account. Often, once the scope of the change is better known, a negotiated price may replace further force account paperwork. GC 9.2.3 requires quotations to be final, but GC 9.2.4 seems to refute this requirement. Actually, this clause was included in the interest of fairness. Just as GC 11 allows for additional reimbursement when site circumstances do not match the information at time of tender, GC 9.2.4 allows for reconsideration of a quotation when unforeseen or unexpected conditions occur between the time the quotation is given and the time the work is to be done. A simple example will help explain this logic. Suppose a quotation was given and accepted near the start of the project, which added some landscaping to the scope of work near the substantial performance date in the fall. Then, through other changes and altered conditions, the contract time was extended to early winter, making new landscaping problematic. As a result, the contractor would have to return in the spring to do the landscaping. This would incur costs that were not anticipated at the time of the quotation. In this situation, the contractor is entitled to apply to the CA for a review under GC 9.2.4 to include the additional costs. Now, obviously, those additional costs would have to be verified, but the CA would be remiss in not allowing this review and making a suitable adjustment. Another type of cost which generates questions to the association is that of standby time submitted on force account forms. Equipment standby costs are those that relate to the ownership cost of a machine, such as capital or lease costs, insurance, depreciation, maintenance, and repair. These are calculated by the machine's owner and are allocated on an hourly basis as part of the machine's charge-out rate. The rest of the operating charge-out rate includes the hourly cost of fuel and lubricants, servicing, and wear parts, which are only consumed when the machine is working. A full charge-out rate includes the operator's wages, whereas a bare charge-out rate does not. In the case of the MMCD, the operator is always charged separately, so the bare rate is appropriate. The BC government's Blue Book sets the rates it allows for each machine and suggests 50% is an appropriate factor when determining a standby rate. So, when would standby time be recoverable? Let's use an example. A new manhole is required on an existing line with the work to be priced by force account. An excavator was needed at the start of the work to dig the location and lift in the components. But then it was not needed while the crews formed the base and tied in the pipes. It was then needed again to backfill and compact around the installed manhole. Is the time between being needed eligible as standby time? The answer depends on whether it makes sense to have the excavator remain at that location awaiting its next task. If the excavator was unneeded elsewhere, or it was impractical or uneconomic to move it somewhere else and back, then the idle time is recoverable at a standby rate. If the machine was moved elsewhere for the interim, then the force account form would not include standby time, but would include the time to move it away and back again. Sometimes employee costs are recoverable for non-working time, that is, labor standby. In the case of the previous example, if the excavator was deemed to be on standby and the operator was idle, then the owner would become liable for the operator's full wages for the standby duration. As another example, should the CA or some other authority entitled to do so shut down the project, then there will most likely be labor standby time incurred. If less than a shift, then payment for the balance of the shift and possible call-in cancellation time will be due. However, if the shutdown is for more than a partial shift, it'll be up to the contractor to justify why the owner should bear costs for non-working labor. In the example on the slide, out-of-town projects often risk losing crew if they're not being paid for idle time. In this or a similar situation, the contractor may apply for labor standby in hopes of negotiating some sharing of these unforeseen costs. I cannot stress strongly enough that it is the contractor's responsibility to properly document and present all claims for reimbursement. That is not the CA's job, nor is it the CA's responsibility to suggest where cost recovery might be possible. However, it is the CA's job to fairly evaluate both the entitlement and quantum of all costs claimed. Most importantly, the CA is obliged under GC 3.6.1 to be impartial when evaluating the performance of both parties to the contract. Failure to do so can lead to a dispute being filed. To summarize, 1. Indirect costs are not overhead, nor are they impact costs. Indirect costs are not normally quantifiable or recoverable. 2. Impact costs are the consequences of changes and extra work and are recoverable with markups as long as proper documentation is provided. 3. General overhead costs are not project-specific and are recovered through quotations or via a 15% markup on force account forms. 4. Project overhead costs refer to costs to run a project which are independent of the work items being done. They are only recoverable if the contract time has been extended and either they are listed on force account forms or on a pre-agreed daily amount. They are entitled to be marked up 15%. Bonds and insurance and some other project overhead costs are legitimate but cannot be verified on site, so require additional documentation. 6. Task overheads has been deleted as a category, but a new definition of other task-related costs has been added to allow capture of costs not fitting existing categories. 7. The markup for general overhead on force account listed items is now 15%. 8. With the change in the allowed percentage for general overheads, the total markup on labor rises to 30.3%. 9. The cutoff for small tools is now $1,000. 10. When requested, a quotation is mandatory but does not have to be explained nor accepted. 11. If work on a change must be started before pricing is finalized, the costs must be tracked by force account form submission. 12. Quotations must state the final cost, but if circumstances change after the quotation is accepted, a review is possible. 13. Standby time must be justified. For equipment, it is normally 50% of the bare rental rate. For labor, it is 100% of the burdened and marked up wage cost. 14. The contractor must provide proof of all costs, but the CA is obliged to be impartial in all evaluations. I hope this video has helped clarify this contract consideration. Please check our website for further assistance and to see what other topics are presented in this series, which now contains over 40 videos. Thanks for watching.